cool. I want to shift the conversation a little bit to the business side of it, starting the business of it. You hear these things, 1031 exchange. You hear own a home and you can write off a portion of your home. You hear if you sell stock at a loss, you can write it off on your taxes. Let's dive into not necessarily those specifically, or we can, but to start an LLC, C corporation, let's talk about the benefits to having a corporation as far as taxes are concerned.
Right. So starting with first, like you can have many different, there's like many different, like not to get too deep, but like let's leave it very like surface level.
No doubt.
It's
No
a
doubt.
lot of information.
We'll be here all day.
Yeah,
we'll be here all day, y'all.
Yeah, so we going to like, you have like C corporations, you have S corporations, you have partnerships, and then you have like LLCs.
Yep.
You can also be considered a sole proprietorship.
Yep.
But actually, like an S corp really isn't a legal entity. It's a pass-through entity that you elect as a. You have to apply through the state, and the S corporation status would allow you to, for tax purposes, to save like money.
No doubt.
So
understand what he just said, y'all. The S corporation is a designation, right? It's a designation for pass-through. So understand what he just said right there.
But it's not a legal entity.
No
so
doubt.
You still got to pair that with an LLC.
Exactly.
A corporation. Those are like the only two. But,
Yep. So give me the importance. Why should I not just do a sole proprietorship with my social security number and a DBA doing business as?
Right. So when you start to go into like doing a sole proprietorship, the taxes is significant. So let's just say, for example, you make $100,000, to use like easy numbers as an example. Let's say at the end, like, so after all expenses, you're walking away with $100,000. When you get taxed, you're going to get hit with federal and state taxes on that money. So if you're in that tax bracket for $100,000, let's say it's 22%. So you're going to get hit with federal 22% and then another, 10% for the state. But like the more money you make, that number could be a lot higher. Let's talk about you make $500,000 this year. And if you just have a sole proprietorship, you'll be taxed on like almost 40% of that income. So
the key, I think, that you just said is because it's income. It's seen as personal income.
Personal income. Because the government, everything that you will make from like the business, you'll be taxed on it.
All right, so I don't want to do that.
Yeah.
I don't want to do that.
Let's avoid that.
All right, so tell me how do I avoid that? What do I do? Set me up.
So then you apply to, like, let's just say you pair that with an LLC. And then you treat your LLC, you elect for it to be an S corporation. So now with the S corporation, you can avoid paying self-employment taxes because in addition to being like let's just say just an LLC, you'll have to pay self-employment taxes in addition to the other taxes that you have to pay. So like that's like, so you have federal, state, and then you have self-employment, which could be like 17%. Then if you choose to be an S corporation, like you can avoid paying the whole like other like 17 because you don't have to pay like self-employment taxes because you have to pay yourself a W-2, and the W-2 you can kind of make that being to the market. So if you're starting a business, let's just say I usually don't recommend people applying for S corporation status until they like make $50,000 of income because that gives you the sustainability for tax purposes and like paying like your accountant where that's fair. So if you're making more than $50,000, you can apply to be an S corporation, and when you receive that $100,000, now you can save like I said 17% of like the self-employment tax.
And every penny counts.
Every penny counts.
So talk to me about, not necessarily, talk to me about this statement or talk to me about the business making the income versus me owning the business. No. Scratch that. Let's make it more simple. Talk to me about the business making the income versus me personally making the income.
Right. So if the business makes $100,000, you will be able to take advantage of some of like the like I don't want to use the word deduction. Let's say like write off. Like let's keep it simple terms. You can write off some things that pertains to the operations for that business. If you are operating in your home, you can take a portion of your home as a deduction, which is okay. That's perfectly fine.
Yep.
But a lot of people aren't doing it the right way though.
Talk to me about that. Talk to me about that.
Yeah.
Talk to me about that.
So a lot of people just think that like you'll take your total home and you'll just let's say you use 20%, and then so you're taking your lights, your mortgage, and everything. You just like taking that 20% and you're writing it off. That's not technically the right way to do it. There's another tax form you should file, and although that calculation is correct, you shouldn't treat that as you shouldn't write off those as business expenses on your Schedule C. There should be another form attached to the Schedule C that you're going to attach to it. And the reason being is that a lot of people are doing it, and what they don't realize is that the benefit in writing like those write-offs is that what's the best way to describe it? The benefit of those write-offs is that what the IRS is saying is that, okay, we're allowing you to write off your home for like the 20% that you use for your home. But let's just say like your income, like you don't make any income. Because it is possible like you might not have a profitable year. We'll talk about that because,
no doubt.
Because we're gonna talk about depreciation.
No doubt.
So there's a possibility where you might not necessarily have a profitable year. So you shouldn't be able, the IRS won't allow you to create a net operating loss. By just writing off your business. So those are disallowed. So you can only write off, mark my words, you can only write off your business home if it generates income.
No doubt.
But you should not be able to write off to create a loss for your home, unfortunately. Now, if you go and you get a building or somewhere external, or even if you have a property and you build a home and you use that separate structure specifically for, then you can take all that expense.
No doubt. So good. Yeah. I might have to rewind that one because you said a lot right there. So, and I'm gonna dig deeper too. Because the other side to it, keep me out of tax jail, Keon. The other thing I think that we conflate, we mess up, we don't necessarily do completely accurate is, I took a family vacation, but this was a business trip, right? So I'm taking all my receipts because we just went to Puerto Rico and I'm writing the whole trip off. No, that's not accurate. Talk to me about that. Keep me out of tax jail, bro.
Yeah. So what the IRS normally do in those type of situations, because if you're making a lot of money, like one of the things that the IRS could do, they can do a lifestyle audit, which a lot of people don't know about. And they'll look at like your lifestyle, they'll dig deep into like your personal transactions, which you don't really like want them to like start looking at your
no doubt. Not at all. Not at all. I want to keep them at arm's length.
Yeah. So like they'll do a lifestyle audit, and the lifestyle audits can dissect your personal, like how you're living, and they can choose whether like what you are doing, what's considered a write-off, what's not considered a write-off. And that's what you don't want to have.
No doubt. So how do I keep them at arm's length? How do I separate? Like I go home to Buffalo and I'm really going home to my man White Party, but the party's on Saturday, but I'm leaving on Friday because I'm gonna have a couple business meetings. So how do I do that appropriately?
And it's fine. It's fine to if you design a trip around and I think it's smart, like even in business, like sometimes you have to send a client, like even working in like a firm, sometimes you might have to go to another city and like be there for a few days to like do like client work. So like it's fine to travel. But there has to be supporting documentation to make sure that, although I've gone for this event, and sometimes events can be treated as like write-offs because, it might be marketing your business at the end of the day, which isn't a wrong thing like that. And that's why I say like sometimes our people, we don't know that. Some people take extreme advantage of it, and some people don't write off enough.
No doubt.
You want to be in that comfortable space where you're making sure you're getting like you're maximizing it. So if I'm going to Buffalo for some production stuff, I still like that trip primarily. I go to Atlanta all the time. Sometimes like the trip is you can write off those expenses.
Yep.
Just there has to be supporting documentation for it.
Yep.
The IRS can't say, "Oh, you didn't go here for this." You
No
know?
doubt.
And just to make sure, like, so if I try to plan like a trip, like a family trip or something, I'll try to do it with like see what conferences and try to plan it around the conference. So like make sure that you're planning vacations and trips around actual business transactions. So yeah, you can hit up Vegas, you know, and not maybe all those expenses are write-offs, but probably like depending on like how you like what the trip is designated for, you should be able to take advantage of a lot of those.